There we go, we are all good. Okay, right, final week. Yeah, I'll start off just to let you guys know on the final week. In fact, I've probably got it up here. There we go. Okay. There we go, that's probably the best way to start. Right. It is final week. One of the things I always suggest, people have got trade ideas and stuff that they're looking at during the final week, send them in. We can go and have a look at them. Go and have a look at how you play it, what you're looking for precisely. The idea being that this can then sort of try and establish what you really want to see with a lot of trades rather than just a good idea. A good idea is fine, but if you're willing to throw it out there, it means you've got a little bit more belief in it probably. And also we can then actually go and look at it and you're going to get some feedback on it. So if there are any ideas people have, chuck them in the group. Be quite specific. So yeah, rather than just generally your sort of hypotheses on what could happen on the day, if there are sort of specific things that you're looking at, specific plays, throw them out there and we can go and have a look at them, go and see how they play out, what you're looking for, whether that's still a relevant trade. I saw a couple of questions around, I saw a question around sort of asymmetry, which relates somewhat to probabilities. I'll come and touch on that today and go and look at a couple of things that have happened so far and what you would be trying to gain from that and how I feel that probabilities would change or where I believe they would change. So let's get to it. In terms of the structure of this week, today you've got standard type form, tomorrow standard as well. I will be giving you a exercise tomorrow, trading exercise, but it's psychology related. So you will get that one tomorrow and then you've got Wednesday morning to actually have a go at it as well. So you can sort of spend a bit of time and just go, right, I'm going to come in and I'm just going to trade. So you can plan, set your day up as you normally would, create hypotheses, plan out what you want to do, but it's exercise time. We'll then go and see how everyone got on that exercise on Wednesday afternoon. Thursday, there's just one shorter recorded session. Then we'll do a bit on strategies. One of the things that I would suggest or ask, or it's up to you whether you want to do it, if anyone's developed any strategies over the course of the course or on the back of today's session or today's pre-recorded sessions, if you're willing to share them, you send them direct to me if you want. I won't name people if you don't want your name attributed to anything, but it's always a good way if you can share a strategy. If a load of people share various strategies, well, you might go away with 20 different strategies. You don't have to use them all. You don't have to even agree with any of them. But if you don't agree with them, it at least allows you to see why other people are looking for certain things. And if you do agree with them, well, it's something you could perhaps bring into your own trading. The way I kind of did the strategy bit is about sort of how do you develop a sort of trade strategy. I'll talk in a moment about the sort of usage of a strategy, because the danger you have with strategies is that they become quite sort of formulaic, or you fit the strategy in. And there has to be an element of what I would distinguish as the idea, and then strategies which allow you to play the idea. I've heard other people describe this as the difference between sort of strategy and tactics. Strategy being generally what you want to try and do, the tactics being how you're going to do it. I'll try and illustrate that in a moment. I got an example of something that I did last week, so I will explain that idea for you. Friday then, final thing. I'll answer any final questions on Thursday. So generally more sort of course related, stuff we've covered, trade ideas, stuff about trading. Friday, Alex does a final wrap-up session. At the moment, it's provisionally set for 12 midday. I would assume that will probably be the case. It will be via Zoom, just for those of you who were expecting it to be in the normal place. So as far as I'm aware, it will be via Zoom. Alex is going to be in the Bahamas, so you can't be doing it from London. So feel free to watch wherever.
If we come into class, it'll just be up on the screen? Or do we...
I believe so, possibly. You have to ask Mike. You will receive an email on that anyway, I would assume, as well with details on it. Once I know for certain when, I will let you guys know anyway. So that's the kind of structure of how it will all work. Right, so that is that for the final week. Okay, so the difference between a strategy or a sort of trade idea and a strategy. So yeah, there's different ways how people want to try and phrase these types of things. Some people call this a strategy, but the strategy is basically break these highs in sequence, tick, 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 and that's the strategy. The tactics around it or the execution of this is, well, how do you actually play this as a trade? It's all well and good to get, and this is what I'd sort of distinguish as, this is what I call the trade idea. The trade idea is pretty straightforward, and this is generally your broad view of what's going on. Trade idea, we're stuck in a range, pennant, if you will, flat bottom triangle, whatever you want to call it. With a sequence of highs, the idea is that once you break one high, that will set off enough stops / trigger enough new buyers to get you to the next high, which will then trigger the next layer of stops and new buyers, and the next and the next and the next and the next, giving you this kind of sort of cascade of buying type of trade. So the idea being that you can actually add on the break of every high if you want to, or you go a different approach and you go bold on the break of the first high on the basis that that's the beginning. If it's going to do it, it will take the whole lot of them out, so you might as well be all in from the beginning. So this is the kind of trade idea. Then you've got to have a sort of strategy around how are you actually going to execute this, rather than just going, well, if it gets to 58, I'm just going to buy it, job done. And that could be a strategy. That is a straightforward momentum break of the previous day's high. There's nothing to say that's not a strategy. But you want to sort of explore, well, what other strategies have you got? And then how do they all actually start to fit together? So that's what I want to try and sort of distinguish between. That on its own is almost too broad. It's a general idea. If you think of it as a football match, you will have a general kind of strategy as to how you're going to beat a certain team. If you're Tottenham, then it's just like being better than Man City, because we are. But no, you get what I mean. There would be an approach to the way that you play, but in the individual moments that make a game, it's about a strategy of how you play certain little phases of play. So it's granularity. So what I'll do, I'll break this down into different ways that you could trade this one. I'll find the date on this. I can't remember the date off the top of my head. But there you go. So the broad idea of the trade is straightforward. It's going to break 58. So I've got all of the highs marked up. So from here, you've got 58, 60, 62, 64, 70, roughly, point somethings on each of them. Sorry, not 60, 62, 64, 70. So that's the idea. Now, these are all of those levels marked out. This is a 1 minute chart when the trade goes. So what you can look at then is, do you have a strategy for each different way that you could play this? And how does this strategy then evolve? Because it's not always just going to play out beautifully and you go, oh, brilliant, I-58, done. With a trade like this, there is an element at point 1, for example, which is the break of this sort of intermediate range. This is way ahead of the level. This is a trade, and the way you've got to think about this is each of these different strategies has to have an element of plan around it and an acceptance of the risks and obviously the rewards of the trade. What I mean by that is you can go for the preemptive break. You can get in long down here. And this also relates to a kind of asymmetry idea. You can get in long down here, which is 53. Now the upside of that trade is by the time it breaks, you're going to be far enough on side that you can probably just sit back and you're comfortable. The downside of a trade like this is that you're also not wrong until it comes back below 53. And you're certainly definitely not wrong until it trades 58. Because until it trades 58, it could still trade 58. So if this sort of does this, it's still okay. So there's certain things that go into this type of a strategy in terms of your willingness to hold, your willingness to sit through large periods of uncertainty waiting for the general idea to play out. So there's that side of it. Breaks 58. Strategy 2 then is a reasonably straightforward buying support. So once it starts to form some support, this is just your simple passive entry type trade. You've got to have a strategy around how do you take that trade on? Are you somebody who is going to just watch this, come back, it stalls. This would be some way you probably employ footprint a bit more. You're looking at that being, well, it's stalled. Here's the strategy then. You can buy at point 2. You're waiting for it to go for the highs. Doesn't have to, but it's a game of waiting. And until the passive buyers disappear, either by way of getting out of the way and this drops quickly, or the passive buyers actually now start to hit market, you are again in a little bit of a waiting game. The alternative is number 3, which is your momentum play. So you then have a different strategy around that. So the whole idea here is you're sort of building up different approaches. See it as a sort of toolbox of trades, that they all play into the same idea, because ultimately all of these trades here, the objective is to get to 70.5. Well, no matter which trade you take on or which strategy you use, how you approach it, you're trying to get to 70.5. So you've got your preemptive, you've got your pullback, you've got your momentum trade. All of these go wrong down here. And even for those who have waited, and equally, I quite like this trade, and I know a lot of people like this type of trade. You let it break the level, the main one, and buy the pullback. In this instance, that would have been horrible because you buy the pullback with everybody else who's also waiting to buy the pullback. The market sits still. Go and replay it. I'll find you the replay of it. In fact, I might have a bit of a recording of it. It sits there and you think, oh, this is all right. I'm in a nice position. It breaks 55 and it stops everybody out. That still hasn't negated the idea. And this is the whole point of it, that the idea has not gone away. If you're in at number one and still very much sticking to your stop, you're still all right. Don't get me wrong. You're very much doubting this trade now. The reason I've used this as an example is I remember seeing one of the traders doing it, and basically he was in from down here and he did stay in for the whole thing. Granted, his size went down to about a quarter of what it was when it came back, and then he pushed it back up, but never up to the same degree, but he did hold on for the entirety. So various other people don't get in, because with these types of trades, you know that everybody else is playing the game as well. Saw people getting in here, saw people getting in here. That was where it started to go wrong for people, or not where it goes wrong, but people going in slightly different fashions. But this is all down to strategy. It's all down to what you prefer as well. The next ones, once it's done the flush out here, it's then a case of, can you get in as we start to break up higher? So once you start getting through the previous levels again, these become the same. You can play these with the break again. As you will also know, and this is where being part of it and seeing it play out, you understand better what's actually going on. Once you've had this flush out, whether you were part of it or not, there's probably a fair few people who want to get long now because they were and they've lost. If you don't get stuck in the, oh no, I've lost, this is awful, and remember the trade itself and the idea itself, buying as you get back through the 58 and 60 area is exactly where you want to be, because you're buying as everybody else starts to come back in, and then finally you get the momentum move through the highs. There's a variety of different approaches. That's my point here. And you've got to have a strategy around each of these. If you've got no strategy around buying momentum through highs, you're missing out on this. If you didn't have that as a strategy, well, chances are you will have lost some money here. Possibly, if you really held on, lost some money here, or at least given it up as we start to rotate lower. So you might have made a little bit and lost it here, and that's it. So you've got to have a strategy around playing momentum. If this had just gone tick, 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 straight up, then without some kind of preemptive strategy, that's probably the harder one to argue for. I think this is always one of these cases where you always know on a trade like this, you've always got the buying the break of the high trade. That's always going to be there. If it's not the first high, it's the next one, next one, next one, next one, but there is a play. The preemptive trade is the one that's going to be at least the most comfortable once it starts going. If you're in this, once you get above 58, this should be reasonably comfortable. It's not in this instance, you have to accept that, but a lot of the time it will be. So it's about making sure you've got a variety of different strategies, different approaches, different ways of doing things. That's a lot of what I sort of try and get at with sort of developing strategy. I used an example of predominantly reversal type trades. But if you've got a number of different ways to play a reversal, ultimately you come back to the idea. The idea is we're going to reverse from here. Well, you don't know how it's going to reverse, and if you've got one strategy and it doesn't do that, it's gone. The opportunity's gone, and then you end up getting frustrated. And you end up getting trapped chasing and trying to do stuff that's just not really that viable. So make sure you're constantly trying to build up a number of strategies. I don't think one strategy alone is going to work. Yes, if you play it extremely rigidly, you know your strategy inside out, and you only wait for the very, very
seconds worth of
Yeah.
holding the trade. Wow.
Yeah, I think he did, this was about 2017, and he did an analysis on how long he'd been in trades for the whole year. Huh? Okay, we're back. Sorry, I'll just finish what I was explaining here, but on the idea of being very, very rigid on a strategy. It was about 2017, he did some analysis on it. I think the entire year he was in the market for about 2 minutes, the entire year. And so you look at it like that, what can go wrong in 2 minutes in a whole year? Probably not much. So that's the whole idea behind the concept. That
Well, it's also a good example of what you perceive to be a successful trader. There are opposite ends of the scale in ways that you probably don't appreciate until you get exposed to it in a professional environment.
Oh yeah, completely. And I think he's probably the example of taking it to the most extreme in terms of taking a strategy and honing the details of the strategy right down. And it's that and nothing else. And if there's any like impediment to the idea, it's not a trade. And that way the idea is that you put in on a trade that almost can't lose.
And that strategy is the same all year round, like all over 10 years or whatever it's still.
Yeah, he that's not his only strategy. Like, he may have 3 or 4 strategies, but all of them have very, very specific criteria and are only played in very specific circumstances. So that you reduce all variance. There's nothing that can influence the trade because you're in for such a short period of time. You're not going to do anything that doesn't have everything lined up for you. But it's a very difficult type of approach, I think. That's from a personal perspective. It's a personality thing. Like I say, it's a way to overcome being extremely risk averse. If you're extremely risk averse, the way to deal with that is don't put yourself in situations where your risk exposure is large. The longer you're in a trade, the more things outside of your trade idea could impact what the market does next. If you're in for a very tiny amount of time, the point where your trade entry is triggered to the point where you're out is almost entirely based on your trade and nothing else because you're in it for 3 seconds.
You said the shorter the time frame, the higher the probability of prediction?
In very specific circumstances, yes. What you're trying to do from a probability perspective is pull yourself to a point where if this happens, the probability of this is almost certain. I'm trying to think of a real life type situation of that. But the kind of moment that if you can enter on that moment, it's almost certain to do the next thing. And there's nothing really to change that. So that's the whole idea around that type of approach. It requires a lot of thought, a lot of time watching, a lot of patience, and a lot of ability to go, no, not this one, and days of not doing any trades.
Oh, really?
Yeah, but the payout of that is if you have days of not doing anything, you don't lose money. If you make one trade and make a decent amount of money on one day, you're not losing it. So you have no P&L fluctuation apart from the one that you lose, which is 1 in 100, and that's your fluctuation. So you basically just go like that. Of course, they don't all work perfectly like that. You may go through a period where it goes down, down. You also have to accept that the losers are not always going to be small. With some of these types of trades, when they go wrong, part of the way that you make money with a strategy that's extremely rigid and extremely infrequently traded is you have to do it with a decent amount of size, which also is a psychological thing of when you lose, you're going to get a big slap in the face and potentially have to sit there looking at that loss for the next 2 weeks before an opportunity comes up. So it puts huge importance on the next trade. And if that's something that you're confident with, there's nothing wrong with doing it or comfortable with. If it's not, it's an extremely difficult approach. No. But on the same basis, there's a lot of people who don't want to be in trades all the time because by being in a trade, that is psychologically tough to deal with, that constant, effectively stress of being in a position where you could be just about to lose a lot of money at any moment. And the more time you're in a position, the more, the sort of less direct strategy related you are and more trade idea based you are, then you are naturally open to more risks. At the same point though, you have to be aware that you're also open to situations where you might coincidentally be long as something massive happens already, and then you're in a good place. Right, equities are open. I'll perhaps come and touch on those in a bit. The opening gap up is starting to sell off I'm not going to call this as it's just like Friday or Monday or Tuesday, whenever it was last week. What was it? High. So we'll wait and see. I'll perhaps come and touch on equities in a moment. Anyway, we'll come and touch on the S&P. Right. This is a really good question. How do you distinguish between a trade strategy going for a typical extended drawdown or something more concerning? This is a really difficult one to sort of have a definitive, that's the line. I think you have to look at a trade from the perspective of, and this is why I would, what I call sort of forward test ideas. Keep tracking the performance of a trade, right? No two trades are ever going to be exactly the same, but you're going to have a certain type of strategy, a certain type of play. If you track the performance of that over time, you're going to have a rough idea of not the probabilities of your trade working necessarily, but a sense of, if nothing else, sequence that you can kind of go, oh, okay, well, this strategy, whatever you want to call it a block reversal. And you look at it and you go, okay, it's one, it's lost, it was one, it's lost, it's one, and then it's lost. I wouldn't necessarily see that as a sign that it's gone wrong, but it would definitely be something that you want to go and have a look specifically here at, are you actually playing this in the same way all the time? So it's not to say that trades can't go wrong and it's all on you, but something that you do want to sort of make sure that you've checked is, are you becoming increasingly confident of a trade to the point that you're now trading it in a different way, that you're executing it differently because, well, it's worked, you know the trade, you can take the trade on more and more and more frequently. You start being in a situation where you see it everywhere. You're like, oh yeah, it looks like that. That must be the trade. Yeah, that type of idea. That would be the first thing. What I would also do, and this is where you want to be sort of coming back to your sort of debrief, which relates as well to the next questions, is keeping a track of your perception of volatility, of theme, of what's going on in markets. Because what you'll be able to see, or what hopefully you see, is that there is a degree of correlation between this sequence of losses and perhaps the market's now operating on a new theme, or now being much more sort of fundamentally driven, non-fundamentally driven. So you can then at least go look at it and sort of say, well, this is now an environment shift. So that's how I'd sort of try and do it predominantly. That if you just look at every day and go, okay, well, is the volatility broadly in the same kind of band as where we were? Are we much more news related or much more technical? So if you look at your vol from low to high, if you're still seeing the same kind of sort of readings or your same qualifications of volatility and the degree to which your market is news-based or technicals, and you are now losing, well, I would lean towards that's got more to do with the way you're taking the trade on. If things have changed, let's say volatility's gone from here to here, and we've gone from technical to news-driven, and the strategy stops working, well, you can look at that and go, okay, well, this is not the environment for it. So I want to sort of stop using this strategy. It's always going to be there. One of the first things I would start to do as well is if you are getting a sense that this just doesn't feel like it's working at the moment, you're seeing all the same inputs, you're looking at the trade the exact same way, and it's not working, and you keep seeing that, you get into the trade, and even at the point where you're in, it doesn't feel like it plays like the previous ones. First thing I'd do is reduce the size. If this is a dip and it's just a natural kind of swing down in the performance of a trade, if you reduce the size down, one, you reduce the losses, but two, you're still doing the trade so that when it starts working again, you're already on it, rather than you sort of going, no, I'm not going to do that anymore. The trade starts working again, or the idea starts working again, and you've then got to try and build up this, oh, it does work again, and start doing it again. So if you cut it right down, you're still giving yourself that chance to learn it. It's going to be something particularly early on as well that you do have to go through these sort of experiences of a trade not working or starting to not work to be able to go, to be able to sort of see it through that period and then be able to go, okay, it doesn't work when we have this type of environment, so you know for next time. So the first thing I would suggest, if it feels like a trade doesn't seem to be playing the same as you would expect, reduce the size to start with. Even if it's an S&P trade, you just go and do it with 1 micro, just to see if it's the case that the trade is no longer working, or this is just a situation where it's much more inconsistent. But it's a really difficult thing to to sort of be able to look at any strategy or any trade idea and sort of go, okay, that doesn't work anymore. The easier ones are sort of order flow based trades or time based trades, which is probably also one of the easier places to start. Time based trades are pretty straightforward because you can go, okay, at this time, I'm looking for the close of the day flows, I'm looking for option expiry flows, I'm looking for auction type movements. Any of those types of things, you know when to look for it. And you can then very easily track the progression of that, of whether they're actually working, whether the market's actually moving or not. Simple order flow trades as well are also quite easy to track their performance. You know, if you're trading someone flipping a market, for example, it works, you make money, it works, you make money, it works, you make money, you lose money, and then you lose a bit more money, and you say, okay, this doesn't work, and you can stop that quite quickly. The generally technical orientated trades are far, far harder because they're the types of trades where you don't get the immediacy of the feedback. So the trade might not work today and it might not work tomorrow, but it works next week because things have slightly changed, and that's always a harder one. So unfortunately, Jason, I can't give you just a straightforward, oh, when this happens, reassess. I think if a trade loses 3 times in a row, it's probably a good point to just go back and make sure, you know, you're kind of checking off, is it a case that you've played this badly or you've misinterpreted it? And if you can say, no, this is exactly how I would play this every time, then you might start to think, do you know what, maybe I want to cut this down a bit, step back and wait until you start seeing the trade working.
I suppose, Richard, also it's down to with what's the actual definition of the edge of that trade? Because having the setup is the execution trigger pattern, right?
Yeah.
But that's not the edge of the trade. The edge of the trade is a number of different other components. And if those still continue to exist, then in theory, you might be going through a drawdown, or as opposed to the opportunity to come very dependently. It's like if the edge was you're seeing a certain condition come up at a certain time, that's likely to be that those conditions cease to exist and therefore that trade idea ceases to exist. But if it's based on the, I think that when we come down to revisit the daily swing lows in an uptrending market, that edge is still going to persist over time, and therefore might be down to other things you need to look at when you're executing.
Yeah, it's a good point actually. Yeah, if you go and actually look at what precisely is the edge in the trade, what's special about the trade, rather than it being, take for example a sort of block reversal type trade. The key to that trade is not just seeing a market go down and trade sideways. The key to that is it needs to have done that at a level. It needs to have done that post a certain type of movement, the sort of general drift, and at the point where it could go again and it doesn't. That's a good example. The Bund today is probably a fine example of that. It's a longer winded one, but it's done that type of thing, which is also part of the point that you have to remember that no 2 trades are always going to be exactly the same. I would typically, if you look at that today, I would typically look at a block reversal idea as being much more short-term based, but this has done the drop. One of the key things I always look for with a block reversal is you're at a point where you're looking for the next leg. These types of trades start off with you looking for the next leg down, and it's the realization it's not happening that allows you to play that up. So this could have dropped, as you saw, into yesterday's range and gone down it. So you're already kind of looking for that, but it never really presents the opportunity. And that's part of the key to a trade like this, or to the reversal, is that there's going to be a lot of people looking for the chance to sell. And without being given a trigger to sell, they're just accumulating passive positions, which is part of how these types of moves happen. So it's the understanding of the sort of structure of expectations that is the edge on a trade like that, rather than just going, oh look, sideways block, buy it. That's the basics of the strategy, and the strategy doesn't change. That buying the momentum on the break of the block is the trade, but when to do it is the bit that makes the trade work. So I think that's part of the point. So not the easiest one to be able to give a straightforward answer on, but think, like Peter said, a lot about what exactly is your edge in that trade, and is that still viable, or is it still there? Hopefully that's answered that. On the point of a block reversal trade, here is an example, because I got a question on this, and there's a couple of things. I'll try and explain the idea of the trade, but something that is probably quite relevant to this piece and well into what I was just talking about is the sort of desire for absolute specifics on things. And the reason that I don't think you want that, particularly on something that is inherently a non-perfect specific situation. the structure of the idea is there, right? This is a drop, you've got a sideways range. You can't see whether this was in a position where you're looking for that continuation element. But on the face of it, the straightforward, simple idea of the trade is we traded up, we traded down, we sit in a block, we've had the attempt lower, delta's flat, volumes are light, and we get that move out, and then you get the pullback and the next leg. So the hallmarks are all there for this type of idea. But what I don't want is to be absolutely specific. You know, this is a guideline. I always use the example of, we go back and use a football example. You can have a general strategy around how your team attacks a corner. So the strategy being that one of your players is going to run from the center of the box and they're going to run to the near post. Now that's the strategy, and that player knows what he's going to do when he gets to the near post. There's two choices. If the ball's short, he flicks it on. If it's not, then he tries to score. Straightforward. But you can't be exactly specific on it. If the ball comes in flat and you say, when it comes in, if you're at the near post, head it in. If the ball comes in at chest height, you can't do that. It's not a strategy, but the idea is still there. Find a different way to put it in, use your feet. But so my point is, you can't be exactly specific on the details of precisely what you do. The idea is there. If the situation arises, this is the ball coming to the near post, what are you going to do? And it's then about, well, how precisely do you trade that? And you don't know until you're in the moment. But the idea is there. The strategy's there. The ball's come in. This is your shot. How are you going to do it? Well, that depends on the way it's trading. Depends on the nature of movement through that area, which is the same as the how does the ball reach you type idea. I really hope everyone's got a bit of sense of football. So that would be the one thing I'd say on that. Concrete example of the idea that I've discussed, so that was this one. If the trade was actually taken in this way, with a portion of it done with large size, that's always a vagary, right? Large size is just purely whatever size you're willing to put on the trade. And the size shouldn't change in any way the way you would take the trade. So how would the stop then be moved, if at all? And again, this, maybe I'm reading this wrong, but the way it's worded implies that the size would influence the way the stop's moved. The stop will move based on whether the stop moves. So could I give an example of number of contracts at each entry and exit on this exact trade? And for context in the example, would that trader's max possible position size and drawdown limit be? Or what would it be? The max size and drawdown is ultimately straightforward. The max size is the max size you're allowed to trade. The drawdown is your daily stop. It's up to you then to define how much size you're going to put onto a trade like this. So to make this simple, okay. All right, Darius, yeah, I got that. So to make this simple, the way I would do it, rather than size, because size is dependent upon whatever money you've got in your trading account, I would do this in terms of clips, which is the way most people split their trades up or split their size up. So in this example, what I'm going to do is say that you have a max of 5 clips. Now a clip is basically your max size in this example divided by 5. So if your max size is 10, your clip is 2. If your max size is 100, it's 20. If it's 25, it's 5, etc. You can do 5 times tables. So what you've got to do then is you've got to look at this and go, right, to start with, is this a full clip trade? As in max trade? I would say no. There's not many situations where I'm going to look at a trade at the point of entry and go, do you know what? That is a full size entry. Everything I've got on this. With a full size entry, it's probably also going to be the size of position that if this trade goes wrong, which realistically when you enter here, you've got 2 choices of stop. Either you enter on the momentum and you place your stop immediately inside the range, which gives you around about a 3-tick stop, or you put your stop the other side of the range, which is going to give you more like a 10-tick stop. So they're your 2 stops basically. You could have a stop of 3, or you could have a stop of 10. They're your 2 options. If you go absolute max, I would suggest probably a 10-tick stop is your day done. That's one of the reasons I wouldn't want to go for this full size. The other thing is, I just don't think that this is an absolute A+ setup. You know, your absolute A+ setups are the types of trades where you look at and go, there is almost nothing that's going to go wrong on this trade. And if it does, it's not going to cost me a fortune, number of ticks if it does go wrong. So on this basis, I would look at this and go, right, first entry, This is the point of greatest uncertainty. If you try and buy the break here, you need the momentum, you need it to break with some extra volume, with some pace. You get that, that for me would be add a clip. So we go +1. You can multiply by that by however many you want. That's the first bit. There's an argument that if you play it as it breaks, you could add another one quickly. The idea behind adding another one quickly here, and I'd certainly on this add, I would keep the stop on that one just inside the range. This add serves the purpose that when we accelerate up, as you start to stall, the idea of the trade is this is a liquidation of positions. So some of these people get liquidated. The idea of this is that as we start to pull back, you get out of them. So you're still only on one clip here. Well, you've got one in now. So you had two, you've now got one. So you banked something there. So you've got that much out of the trade so far on one. The next part of the trade, and this is where you have to accept that it could roll all the way back and stop you out, is to try and buy passively at the top of that range. So that's the next part of the trade. That for me would be another add of 1. So you basically increase your position back up. Again, you've now got a choice. I would make an argument that you could actually move your stop up now. You really shouldn't fall back inside this range. If it was going to go wrong, it could test out, fall back. Sorry. It could test out, fall back, stop you out, do this and still go up. It would be annoying, but it could happen. So you kind of got the element of that's why you have the bigger stop. Once it's proved to you that it's outside of the range, then I think you can bring your stop up if you want to be a little bit tighter on your stop there. So you bought two, you got one out, you buy another on the pullback. This would then be the point where now you've got two clips in. My first thought on this would be, I want a break of the high. Don't want to get out here. It's an easy argument to go, oh, you just cover one there. I don't think you want to do that. You want to try and hold both through there. That's your target. And your target's always going to vary as well. You know, whether it's the high of the day, in this instance it would be, it's the next logical target. There may be other scenarios where it's somewhere completely different. You know, the Bund, for example, today, I think you were in an uptrend, it would seem sensible to go for a bit more than the high of the day, you know, because of the way it's traded. The idea here then is that you add again on the break. So you would now end up running 3 clips for your big target. That's the idea of the trade. This is the hard bit in terms of moving a stop. So you've got one in from here, you've got another one in from here, you've got another one in from here. You can, in this situation, then move your stop up and play the idea that, well, if this fails to keep going and comes back, you get them all out and you're out here, which means you take a small loss on one and you get the win on the other two. Not a bad result. I don't really see at this point, once you've broken this high, why your stop still needs to be down here. So that's how I'd consider moving it. Probably, as soon as you've got some small highs here, I'd get the stop below that. So that'd be where the stop would be placed. And then, like I say, you're going for the high. When you get there, my view on trades like this, don't sit there going, oh, I wonder if it'll do more. It gets there, just get out. So -3, you get out of all of it. That's how I approach that trade. So, you know, do that with whatever size or multiply those numbers up however you wish to work it out. But if you think about a trade from that perspective, whether that is a clip of 1 and it's a 1 lot, or whether it's a 10 lot or whether it's a 100 lot, the trade is exactly the same every time in terms of the way you manage it. So you look at this and go, right, broadly this is a 3 clip trade, these are how I'm going to put them on. It starts off as a 2, and if this straight lines straight to target, you take 2 lots or 2 clips for the whole move, and that's it, nothing more. If it gives you opportunities to add on, that's where you can then add on. But on the point of sort of asymmetry and probabilities leaning in your favour, this is the point where it really shouldn't come back. Yeah, that's the point of no return. The probabilities of reaching here now are great enough that this is on its way. That's how I try and sort of view that. So hopefully that gives enough specifics on that. But that's something, that's where you want to get to. Really go through your trades and ask yourself, go through it from a theoretical point of view and ask yourself what the value would be of X size at different points, how you would manage that, and what the risk in that trade would be at different points in time. On that point, one of the ways that you really want to be trying to think about these things is from a probability perspective. So if you take the S&P, for example, what I'm not trying to do is assign probabilities to things on a case of going, right, I've got 100% and how am I apportioning this? What I'm more looking at is the idea of where do things change and when you get to certain points, what do I think the probability of a certain type of action is? That'd be the way I'd try and look at this. So, on that point, my sort of quick views of S&P. This is from an hourly perspective. Now, from an hourly perspective, I'm looking at this generally with a bullish look, with a bullish view now. You've got the gap up. So, this red box here, which is 86 to 92, is my point of well, sort of inflection and where I think probabilities can turn. So one of the things you've got to think about when you're looking at any trade, which is why I say you can't just start with 100 and an attribute across the board, is in any individual trade, you've got to look at this and go, okay, well, what are the probabilities of a move to somewhere else on the back of this level holding, breaking, etc. So let's say you're playing a market, playing the move down. You'll play the move down towards 86. This is the point where the probabilities can change dramatically in your favour. But equally, you have to be aware that that is also the point where this could also turn straight back in your face. So if you're looking for a move down, whether it breaks the level or doesn't, I'd say is probably about 50-50. So you're not trying to assign probabilities to whether or not a level is going to break. What you're trying to do is to understand the probabilities of a break resulting in something else. So if you are playing this to the downside and you get here, if this breaks, I would say then the probabilities of going to 54, which is kind of the next area of support, you've got this, whoops, terrible drawing of a line, 54, 58, 62 area. The probabilities of getting there on a break of 86, I would say are pretty high. When I say pretty high, I'm talking about 75% chance. That's how you can look at things from an asymmetric perspective.
So when we close, it has to show more selling pressure. Like it can't just consolidate in that area and then go back up.
Yeah, exactly. So yeah, the point where the probability flips is when you actually get through 86 and you go, right, now it's on its way, rather than, yeah, just getting there isn't enough. It's got to actually get through. The specifics on the what you constitute through is that's the grey area part of it. But yeah, the idea would be once it's through 86, the probability of going down here, I would say goes up and up and up. But if you're looking at the probability of going to 54, until you get below here, at best, well, actually, I'm not even going to go as far as it's 50-50, because the only way this becomes probable is you've got to actually get through that level. So I'd look at that and go, well, you're looking into the realms of 10% chance. You're in a bullish market, above key area of support. Why should you believe you're going to 54? So any trade you play from higher up looking for 54 is, in my view, in its nature, asking a huge amount, that you're going to run to the most obvious area of support, and then only if you break does 54 even become possible. So it's one of these, and this is where the concept of asymmetry comes in, that 54 is not possible. If you break 86, suddenly it's very possible. And that's the point of this idea, that when you tip beyond that point, now you can go for this because, well, everything's suggesting this is now on. But until that point, it's, everything's speculative in trading, but it's a speculative idea. If you're short from here and it comes down, it could do that, but you've got no more information to suggest that it will until it gets below 86. That's what I'm sort of trying to look at from a probability perspective. So the same with the idea of, can you break the record high today? That's a trade where I would put that as more likely than going to 54. So if someone's asking, and this is where you've got to try and think about it, it's not about probabilities of one thing over another necessarily, but if someone said to you going to go 54 or record high today, if pushed, I'd say record high is more likely. That doesn't mean I think it's going there. So what you've then got to ask yourself is, at what point do I believe the probabilities of going to the record high significantly tip? Because anywhere in here, I think looks good to go record high. Whether it's going to today hinges for me on this 35 area. If you get through that, you've got, it's a bit scrappy because you've got 35, you've got 40, you've got 43. So there's a few bits along the way. But if you get through 35, I would say that's the point where the probabilities start to tip. And once they start to tip, now you can sort of go, okay, I can justify playing for this. Incidentally, we went to 40 and we backed straight off. So this would have been one where the probabilities tip very much in your favour and then turned against you. When I say they tip in your favour, it doesn't mean that this cannot go back. What it means is that there's very few reasons for this to not keep on going up. That's the whole idea of it. There's not much left in your way. The probabilities as well, before anybody wonders, are based entirely on your own view, from experience, from essentially a way of you assigning conviction to a trade. So that's kind of the way to look at it. I'm not sort of back testing these types of ideas and kind of statistical probabilities on these types of things. Again, you go back to sport. You don't have to be a statistician to look at certain matches and look at the way it's being played and the score and go, well, this has got a very high probability of being this team to win over this team. You don't need all the back history. You just need to have some degree of experience of watching that sport to know that the probabilities are very much in favour of one team or another. I think probably a better example today is the Euro. So what we got in the Euro, on the back of this, my view on this is the probabilities of going up rather than down are skewed, which is the definition of a market that you perceive now to be bullish. Doesn't mean I think it's got drastically high probabilities of going up, but I would put it perhaps 60-40 to go up. That doesn't distinguish how far, but I would put the bullish argument on a higher sort of plane. The area for me then is 08 to 24. So this area here is the point where I would view the up move is now very much on. So from a broad perspective, once you're up above this area, so 08 to 24, you're through that. So up here, I think the probabilities of going up are going up quite quickly, i.e. you're now looking at say a 70% chance of going up towards this area. It doesn't mean it has to do it today, but you're trying to sort of look at it and go, okay, well this is the point where if it's gonna go, this is where it's gonna go from. Which it does, it gets up there. If anyone's watching the Euro at the moment, it got up there. This is exactly the type of trade where the odds start stacking in your favour. It trades above 23, 24 area, yes, this is on, and then it rolls back down. And it has since then rolled back down to 08, I think, and you're sitting on it. So this then is your kind of last chance. From a broad perspective, I'd still say the probabilities are going up and say 60-40. If it goes through 08, that then flips quite quickly. So what you're trying to define is these points where the odds are going to flip, and then you can, okay, now it doesn't look very likely that we're going to go up today. Doesn't mean overall it won't. I think to change the general idea of this market going up, you've got to get down here, probably really through this range. So that's the broad view of it. But on today, the probabilities of this going up, i.e. breaking the highs, are decreasing quite rapidly as you break through this 08 area. So if you're looking for a short, the probabilities of it going down have suddenly flipped in your favour. They probably flipped really when it went back through 23, because you'd got that situation of people getting long up here. And this is where as well, probabilities change. The more time that we spend up here, in this area up here, the more the idea of a move down being playable increases. And this becomes a much more viable trade there, to play that down than it did previously, because of the fact that people have clearly got themselves long up here. So you've always got to think about this from this sort of time frame and what precisely you're looking for. But if you start to tip through 24, the probabilities of trading 08 are pretty high, because that's the next area within that range. If you break 08, then you start to see the probabilities flipping as well in terms of people getting stuck and they're all stuck long, and it starts to roll against them very, very quickly. So that's kind of the sort of concept of probability and asymmetry. So hopefully that kind of gives a little bit of clarity on that. Be interested to see just now, I'm just looking at the S&P in terms of...
There's epic battles going on around like 622 down to 619 about 5-10 minutes ago.
Right.
Loads and loads and loads of volume. Like two sides really battling out to try and make a big push. Buyers managed to absorb all the selling aggression. And now, so it's gone. We're going back up the other way.
Oops. Yes, it's starting to build that volume up in here, isn't it? Now go on to 1 minute. It's done a very similar move to the Euro actually. It's done the move up, got to the point of no return and then giving it up. Yeah, you're definitely, you feel like you're in an area now of indecision, and it's going to be all about the escape of this zone here. You long or short? Or nothing?
4 trades have been long, all of them long, 2 of them successful, 1 of them scratch, 1 lose. So I'm long again from 17.5, 17 quarters.
Nice.
trying to get one scale for the open. So I suspect that we sell a signal into sell the open.
Oh yeah, around 26, yeah.
Front of that, just try to get out.
Yeah, particularly as you've got that reference that it has held that twice already. So yeah, you're basically playing it up the range, and then that becomes the, exactly that. That's the sort of inflection of if it's going to go up, it breaks here, and well, it's hard to see why it doesn't go 35.
Yeah.
But
And probably later in the day, make a little nick for a little bit higher.
Yeah, I think so. But yeah, at the moment, this is absolutely trapped in that indecision moment, which is quite common on the back of a gap up. You know, if you're a buyer,
14 handles on the gap, was it?
something like that. Yeah.
That's also, it comes back to saying, I always like the theory that on a big gap up, a lot of people that want to accumulate haven't had the opportunity to accumulate. They're not going to want to accumulate at the top of the opening price, right? They want to try and drive
Precisely.
it down to do some more volume to get into the big window.
Yeah. So buyers have no incentive to chase this up, and sellers have no incentive to sell at low prices because, well, they've already got burnt selling at these prices. So all the sellers sit up here, and all the buyers sit down here, and everyone waits, and you end up with this kind of bouncing type of action. So you know, you're getting what you'd expect to see in my view here. Particularly as we had the chance, it went for it and it failed it. The only thing perhaps left is it willing to go for the downside and see if it can do that. But you know, this would be one where you'd look at that and think, well, if it was going to, surely it should have. It got back through the open. We've sat down here. The more times that it fails to go from here,
Got a lot of progression on this tape, on the selling on the tape though.
yeah,
These prices.
There's a lot.
and it has got a lot of negative delta on the way down. Now, if you look at that, pressure selling. Well, this is the point. If it's going to do it, you'd want to see it do something slightly different here. You're still seeing that delta coming in. It's not really letting it off.
Yeah.
Yeah, you could really see that, couldn't you?
It's a break, right?
Yeah. Oh, whoops. Yeah, so now you've got to look at it and think, well, not necessarily to close the gap fully, but the overnight low would seem like, you know, the obvious place to go looking. You just want to see that delta keeps on coming down. This is the big threat to the sellers now, that they got their push through, the delta, and then they sort of, you know, the selling gives up, and you get that rotation back.
That's the sellers getting absorbed. I mean, the buyers, right?
Well, yeah, so if the delta goes down, there we go, it's starting to get a bit more. The delta starts to go down and it doesn't keep on, and the price doesn't follow it, then what it's showing is sellers are just selling and passive buyers are accumulating. And if that happens, then you've got a situation where these sellers then are vulnerable, that if it starts ticking back up, they're the people who are going to buy because they're the ones who've been selling and selling and selling. So we'll see, you saw it, like you said, Peter, you see that difference. That's the kind of thing that you can't, the chart doesn't really tell you that. You were just stuck in a range, but if you see the difference in the way that it trades, it just gives you that bit of clue to go, okay, this time's slightly different now.
Well, you start to see the change in double prints on the bids and offers to triple prints. So like 50, 20s, 50s, 30s, 60s, up to 120, 200 contracts traded, right? Which is like you're seeing a sudden increase in the volume going through at those prices.
Yeah, precisely.
The evidence of the step up of aggression.
Which is always what you want to see, and as soon as you've got that, then you've got that little clue. It's got that, it's had this the other week as well. It's a very similar type order flow. That it has this kind of stickiness and then pulse, and then sticky and pulse down. You've got to start looking at this and thinking, well, it's not overly dissimilar to what we've seen before with these types of actions. And it does this, and it starts to go, and then it sits, and it sits. There you go. Even then, traded back 10, and it's just pulsed down again. I'd expect a degree of stabilization on this, but for anybody who is just looking to purely just hold and hold and hold this, you've got 05, which is your overnight low, and then if you go through there, 94, and if you really want to just go, I'm going to hold, well,
Are all the equity indexes coming off? What's Nasdaq doing?
yeah, Nasdaq's the same. In fact, Nasdaq's through its gap. Nasdaq's closed the gap from Friday,
Yeah.
so we bring you a Nasdaq chart in.
On Nasdaq, I wanted to
That's
ask,
where your Nasdaq is.
Sell it here.
No, I already sold it, but I mean,
Gotcha.
do you play through the gap, or
Well, this is the decision, right?
because
You can either play it that you're inside yesterday's range and therefore the move is done. There's nothing more to do. Or you go, well, we're inside yesterday now. I'm going for the move down through that sort of bulky looking value area and play it all the way down. So it's kind of a preference. If you're already short, you're given the luxury of being able to go, well, once you're inside, I'll stay in. If it starts coming back, I can give it up. The S&P didn't give you that. It never broke the overnight low. It never got inside yesterday's range, so it kind of wrecked the ability to give the trade up. With the NASDAQ, yeah, you're in that situation. So this is exactly that kind of example of probabilities, right? If it starts to trade inside yesterday's range again, so it sticks down there, then I think the probabilities of continuation look high. Equally, this is the point that if it's going to bounce at all, this is the point it's going to bounce from. In fact, the S&P won't even get that far. This is probably leaning you towards that. So yeah, where were you in from? What's the play now?
I'm short from 21,072.
Oh well. So somewhere around there. Well, you've got 0.72.
I have the high. Yeah.
You've got the high.
Yeah.
Well, I think then this comes down to a question of what are you really looking for? If you're not,
to be honest, the gap close is enough. I was just asking you.
Yeah. I think if you're in a trade like that, still what a lot of markets are doing at the moment, they're just not sustaining the movement. No, the S&P, look at that bounce and almost no change in delta. So it suggests this is just a bounce on effectively sellers just getting out of the way. It's not great indication because if the sellers are just getting out of the way, this is one of these horrible situations to be in where you're in a trade, everyone's getting out of the way. There's only so far this can go back of you going, wow, this is not that genuine a bounce before actually you have to give it up, because if it starts going up here and you're like, yeah, but this isn't really a bounce, which you're probably right on, it becomes a bounce because everyone else is then trapped thinking this is going to be a disaster if this keeps going. And that's always the horrible thing about trades like this, or situations where you're in like this, you're looking at it thinking, I know this isn't a legit bounce or particularly strong based on the delta, but equally I can't sustain it, and it's less about whether your idea is right, it's more about whether you're in a position that allows you to sit through that. On the NASDAQ trade point, if you're in from the top, I think this is one of these situations where you have the luxury of being able to say, well, as long as it's below the overnight low, I can place a stop and I can play for the big one. You've got to define what the big one is to justify whether it's worth doing that though. So, if you're going to play for it to take out this whole range here, looking for something down here, then I think you could look at that and go, do you know what, whack your stop up here. If it doesn't go well, you're going to take what, a 100 tick winner? Sorry, you're at 21,072, 200 tick winner if it doesn't go well. If it does go well, you're taking another, what's that, 950, another 300 on top. So if you think that's viable, keep your stop up there and leave it. If you're not entirely sure on that, I think it makes sense here to give that up, because the probabilities of it doing this and not changing, I would say that's still a low probability at the moment, particularly based on how far you've come. So you're giving up a lot to play for something that, until you're down here, I think is pretty low probability.
Yeah, no,
So,
I got up, to be honest.
Yeah, that would be my kind of interpretation or way of looking at that. S&P now, and this is now, if you're not in, and this is partly explains why these types of things then hold. Because anybody who's like, oh no, it's going to go, it's going to go, it's going to go, if they didn't get out, they're now looking at this 2880-ish and thinking, okay, if it goes back there, I'll probably bank that. So now you end up with more people at that level thinking this is a buy because they didn't get out previously, and they're all now of the view that this probably is as good as I'm going to get. And that's what gets the level to hold. It's also fuel if it does go, because then they all have to chase because they're regretting getting out. So you kind of see how the sort of psychology of the market changes. It's all markets seem to have this quite sort of skittiness to them just at the moment. It's a hard one to explain, apart from you get that sense that there's nothing, not genuine, all the orders are real, but there's no genuinely sustained move. Every move that starts seems to have this ability to just completely turn around, even when it gets to a point of looking particularly strong or particularly weak. The euro above 35, for example, the Bund below 31, the S&P below 17 just now. Every move that, even when it looks ferocious on the beginning part of it, doesn't seem to have any sustain to it. And that's something that, again, it's worth tracking. Yeah, how do you, and tracking, like, how do you actually respond to this and how do you trade around these types of things? Because this starts to affect the execution of strategies. You know, you start looking at things and going, okay, well, I like the idea, I like the way it come down. Don't go asking for too much. If it starts to look like it's struggling down at overnight lows, for example, just give it up. And you end up in a situation where you start giving trades up quicker. So that's not necessarily a good thing, but if that's the way the market's playing, then that's what you have to do. Right. Okay. Right. Let's come back to this one. Yeah, very dubious about the S&P's.
Where do you get that cat from?
Sorry?
Where do you get that cat from?
The S&P, I'm increasingly less looking for it. But yeah, that's when you're looking on a short time frame, I'm increasingly less looking for it. Do I think that the gap fills out of the question? Probably not yet at least. Yeah, and this is, like I say, this is part of the way you have to look at these things.
You sort of like that.
Sorry, yeah. This is where you have to look at things through, you know, from sort of an in the moment perspective and go, well, the idea of it filling the gap is still on, and until I think you get back above this area, this 20, where we kept on just holding, it was the low of the initial drop, till you get back above there, I still think this is viable. So the probability of it, you know, is probably 55 to 45 in favour. If you go back above 19, 20, that switches quite quickly to, you know, 30% probability, be the way I try and sort of look at that. So yeah, and that's the whole point about, you know, when you're looking at any individual trade, it's about, is it doing it now rather than is the idea still there? Because this could work, but if the S&P is going to trade back to 30 before it goes, your idea isn't going to work. And that's the bit that you've got to try and manage. Right. Quick question on, do you find it reasonable from here to target 21,020 and 2150 on NASDAQ? Reluctant to ask as it might just collapse. Well, don't be reluctant to ask because it might collapse. If it collapses and you're wrong, so what? It doesn't mean anything. You know, if you're looking for it to go back up here, you've then got to ask yourself, is it reasonable? Absolutely, it's reasonable. Is it going to happen, or do I think the probabilities are in favour? Having tested the area of support and not broken it, I would say you're looking at a reasonable possibility. Is it that high a probability? No, because you've got hurdles along the way. You know, your first hurdle is the overnight low. Your next hurdle is the top of this little range here. Then, yes, it becomes possible. So yes, these things are possible. The probability of it going back there, I think at best at the moment is 50-50, but it's reasonable. Yeah, it's not out of the question. If your question was, do you think it's going to go to 2,300 today? My answer would be sub 5%. Do I think it's going back to 2120? Yeah, that's entirely reasonable. You're still within the initial balance. You traded up, you traded down, you're back here. Could it get back up here through the initial balance? Yeah, absolutely it could. So it's pretty reasonable. What you've got to ask yourself then is, at what point do I think this turns from reasonable to probable? And that's the point where you want to enter a trade. And I don't think we're there yet. Okay, that's an interesting question. I'll cover quickly. With your experience, what play games have higher probability of winning? So I think, so what's got a higher probability of winning? Trading the open at the first minute of the morning with the pattern, open drive, etc., or waiting for a point of reference in the profile, addressing it according to analysis where the market will be heading for this morning. I would say the second. The probability of getting things right off the open, literally straight off the first minute of the open, that of all the situations, is probably the biggest, your biggest crapshoot you're going to have. It could be anything. You don't know that somebody really needs to get some business done. Bang, open, buy the S&P. Open, sell the S&P. You have no idea. And that would be the point I would actually say is the most dangerous time to jump into a market. There are certain scenarios on opens that are very playable, but there's not many first minute trades that you can go, yeah, there's something in this. I think probably the most appropriate strategy in a first minute would be to go bid offer at certain levels and see if it goes there and back. But that, again, is the type of thing that it could work and you get paid all right. A lot of the time you won't get hit, and another time you get hit and you get absolutely run over. You're not really playing with any kind of edge there. You're just playing vague probabilities and probably a desire to chase the most immediate thing that happens. Your market goes tick, tick, tick up and you go, that's it, buy. Open drive, and it goes tick, tick, tick down. And you just end up being sucked into chasing the market. I think you're better off, unless, and this comes down to this question of absolutely clearly defined trade idea. If you've got something perfectly defined and everything stacks up, go for it on the open. But chances of that happening are very low. So you're going to play, I don't know, maybe 1 in 10, 1 in 20 opens, you're actually going to get in on the first minute. Much of the time you won't. I would generally say, as a good starting point for anybody, and probably a reasonably straightforward rule to anybody of any level of experience, if you're not 100% certain at the open, leave it 5 minutes. You're not going to miss anything in 5 minutes that you can't do later on in the day. There's very few scenarios I can ever think of where within 5 minutes, all the action is done and nothing else is going on. Unless your market goes open, limit down, and that's it, there's very few situations where you won't have something else to do that will be equally as sizable as whatever a market does in the first 5 minutes. So don't feel that you're missing out. It's hard to do because the flashing lights come on and it starts moving and it's really easy to jump into. But it's a good sort of simple rule. Give it 5 minutes. 5 minutes, step back, and then make a decision. Yes, Joe, I will check that. Right, couple of very quick ones. I'll just wrap up on since we're past 3:30. Market by order, I don't think is particularly important. I think if you really want to get into this kind of stuff, you might be able to infer something from it. But the idea of market by order is that, unless it will show you, I know Bookmap says that it can, unless it will show you the orders and where they move specifically, i.e. effectively the trade mnemonic, which you can't know. But if you can say, right, that 30 lot has not moved, and so that is nothing unique, it's not new, that might have some relevance. But I think what you end up doing is delving down a rabbit hole that you're trying to find something that you're not sure what you're trying to look for. If my 30 lot on the bid doesn't move for an hour, and then it gets within 2 ticks and I pull it because I don't like the way it's trading, is that particularly relevant? But you could end up interpreting relevance to that, despite the fact that I feel it's probably got very little. So no, you can find this information out probably quite easily online. For example, if you've got a 300 lot bid, is it one big 30 or one big order or 30 small orders? You can look it up, the sort of average, the average size of bid in a market. I believe that the average bid or offer in S&P is about 3 lots. It's not that big. So on the point of knowing that it's 30 orders makes 300, if that becomes 31 and it's 500, you know what the one is. So often it's just as easy to go, well, most prices are 300 lots, that's 500. Let's make a fair assumption that there's not suddenly more people who like that price, it's probably one person who likes that price. I think it's one of these, more detail, more complexity, less clarity. Do I value time and sales? Personally, I don't think it adds a great deal. I think footprint, you've probably answered your own question. So no, I don't. If you want time and sales to highlight particularly large trade sizes, that can be useful. It's quite helpful going into closes. So I wouldn't dismiss it, but be specific on what you're using it for. Otherwise, it's just one more flashing light to look at. I don't bother looking at open interest, to be honest. So the idea being, look at how open interest changes on a liquidation type day. To be honest, I don't. I think it's one of these things that if you think it's a liquidation day, seeing that open interest has changed by a small amount is not really going to change your view as to whether that's a liquidation day. Maybe there is something in it. You would have to go and research that yourself. Go, right, every liquidation day, how does open interest change, and then what is the follow-on move? And see if there's any link between the change in open interest and the follow-on move. Because unless you're looking at the follow-on move, whether open interest went up or down doesn't change what you're going to do on that day. So hopefully that answers that. I know there's a couple of others, Kevin. I will answer those as well via message. On that note, I'll wrap it up there. Psychology tomorrow, get your questions in on that. There's usually a few interesting ones. More the idea is to kind of illustrate some of the psychological sort of, I never have quite the right word, challenges perhaps that people will face in trading as a way for you to kind of go, oh, okay, yeah, I can see that as something that I do or something that I don't do. And helps you sort of make some, or helps you sort of see through some decisions. I'm not a psychologist. These are just things that I've seen and other traders have as well. So we'll cover some of that tomorrow afternoon, and I'll set you a little task. See you tomorrow.
It feels like it's going to break lower.
It feels more down than up, yeah, I agree.
Richard, by the way, when you're looking at the inflection point or a point where you think that the market is going to reverse, are you taking a negative delta from the cumulative delta indicator or from footprint?
The
Like to say it's a high positive delta or high negative delta.
I'm taking it from the